Hi, I'm Jeremy Roll, and you're listening to the Passive Investor Show.
The views and opinions provided on this show are for informational purposes only and should not be misinterpreted as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, please go to passiveinvestorshow.com. Hey, PI listeners, this is John Fortes. I'm making it a point to speak to as many investors as possible. My goal is to position myself to be a blessing to my network through conversation. How could one be a blessing through conversation? The easy answer is by listening. A simple conversation can open many opportunities and doors. I always ask myself this: what do I have to lose by having one more conversation? Going back to high school, I've connected friends and family in my network to one another, even if it didn't benefit me. And I continue those same principles and practices. Why? Because it's the right thing to do. If I can't help you, I probably know someone or something that can probably solve your problem. I'd love for you to become a part of that network. Go to www.johnfortes.com, create your investor profile, and schedule a call. How can I best serve you through conversation? In the words of Clarence the Angel from It's a Wonderful Life, no man is a failure who has friends.
And now, the Passive Investor Show. Here's your host, John Fortes.
Welcome, PI listeners, to the Passive Investor Show. I'm the Passive Investor Consultant, John Fortes, your host of the only ranked podcast for passive investors in multifamily syndications and real estate funds. Our goal and purpose of this show is to be a resource to investors and help them master their passive investments by beating inflation 1% at a time. Just in case you didn't get enough of Jeremy Rowe, we brought him back for our infamous quick hitter segment, part of our Investor 101 series. It's great to have you back, Jeremy.
Yeah, thanks for having me on. Hopefully this will be helpful for your listeners.
No, thank you for your time, man. It's very, very beneficial for everybody listening. Now, when it comes to multifamily syndication opportunities, how do you analyze investments prior to investing in an investment?
Yeah, great question. Now, I'll do my best to try to answer this in one answer. It could be a very long hour conversation. But first thing is, I look for people who are experienced. And, I typically look for someone who's got at least 5 to 7 plus deals under their belt, preferably more. And I will look for someone who is obviously in the same market that I'm targeting. So so number one is I tend to, let me actually go through should I go through my box, or do you want me to just tell you, should I assume that everything fits my box and then I'm just trying to figure out how to weed a deal out?
Now go through your box. I think that's the value right there, where your box.
Yeah. So, just to be clear, like, this is what I target. There's 1,000 different ways to invest. None of them are wrong. It's just the most comfortable fit for me. But I'll typically invest in a Class B multifamily opportunity, what I call an A- or B market, typically outside of volatile markets like California, New York, where the prices go up and down a lot because I'm looking for stability. And outside of hot markets like Denver and Seattle the past few years, in that, just the prices got so high that the cash flow was just too low for someone like me. So I tend to stay away from what's hot and trying to get a little bit higher levels of cash flow. I tend to target something that's over 100 units for diversification, tenant diversification. I tend to target something that's stabilized or maybe minor value add upside because I'm looking for a lot of predictable cash flow. So anything beyond kind of minor value add upside becomes a little less predictable in terms of how it's really going to turn out and what the timeline is going to be, at least for me. And then I'm looking for someone who is looking to underpromise and overdeliver to build long-term relationships with investors, so meaning they're conservative, right? And that's really one of the keys, because that's really the best personality fit for me. So that is what I'm looking for. I'm trying to avoid someone who's looking to overpromise and then underdeliver potentially with really nice looking numbers. And then I'm just trying to avoid someone who's creating bad expectations, or at least challenging expectations, because it's just not a good personality fit for me. And I feel like they could be overpromising in other ways as well. And that's just not a good fit for what I'm looking for. That's just a starting point in my box. And of course, I'm looking for something that's stabilized 80 to 100% occupied and may or may not have that value at upside. That's optional to me. As far as how I weed a deal out, one of the first things I do is I look at the cap rate. And the reason why I look at the cap rate is because I invest mostly in stabilized deals. And what that means is that we're not going to add a lot of cushion normally, right? We may add a little bit in the business plan, but we're not looking to do development where they're buying a piece of land and building an entire building, and then you're adding a ton of value, right? And a lot of cushion on how you're buying the property. So the very important thing for me to understand first is what multiple is somebody paying, which is essentially the inverse of the cap rate. So if I feel like someone's paying too high a multiple, I'm going to have to pass because I'm not being careful with the price that I'm paying for that asset, and I'm not building in a lot of cushion after that. So you got to buy it right. That's very, very important. Okay. Number two is after the cap rate, is it really the right profile for me? Is it really class B? And what I mean by that, and this is actually a really interesting thing to consider. When I started investing, class B was probably like 1980s build, garden style type building. And some people still consider that class B, but because I have to think far ahead, because I normally go into like a 10-year opportunity, for example, I had a very sponsor I invested with many times made a very, very smart suggestion to me several years ago. They said, we're no longer investing in anything we consider class B that doesn't have a 9-foot ceiling or more in the actual unit. And I said, well, why is that? Well, they say, look, that seems to be the trend for younger people to want the higher ceilings. And if we buy an 8-foot ceiling, typical building or lower, then we can never change that. That is structurally cannot be changed. So even if the building looks nice, if it's got a lower ceiling, that may have less demand in the future. That may be considered, that may move to like a class C categorization just because of that one point down the road, right? A structural problem that cannot be changed. So that's one thing that I look for now, which I thought was very smart in terms of thinking ahead, regardless of when it was built. And you'll find a lot of product in the 1990s and newer, especially 2000s, have been built with higher ceilings. So you kind of take care of that problem with the newer building, obviously, right? But I see some deals sometimes that are 1970s where people say it's a class B, and that's a little subjective, right? You're not going to find like a class rating when you're looking at a listing, right? It's actually subjective. And that's something I tend to stay away from. Even if somebody says it's class B, I want to personally believe that it's class B and believe it's going to hold as class B status, because when we go to resell it, you're buying a class B today, but you're reselling it at class C. That's never good, right? Because we're not creating any padding to begin with. And now you're going to get a lower price probably down the road and a higher cap rate as a result of that moving from B to C. So that's very important. After that, I'll dig into the returns and make sure that it's going to hit my cash flow criteria, right? So typically, if the cap rate is right, it'll meet my cash flow criteria. But if it doesn't, or if it looks unusually high, that's where I have to dig in and understand why, right? So if it isn't roughly at the cash flows I'd be expecting based off the multiple we're paying, does that mean that the management fee is much higher than I'm expecting? Does that mean that the expense ratio is higher or lower than what I'm used to looking for or seeing? And you got to dig down and understand what's going on. Sometimes there's really good reasons. So here's some just easy examples. If you're in a cold climate, it might be that you're heating the common areas, and it could be very expensive and very cold, and that can increase the expense ratio, right? There could be snow removal, that can increase the expense ratio, right? Conversely, if they're using what's called RUBS, or if they're kind of like, the water is properly be billed across everybody and all that's like maximum efficiency, you may have a lower expense ratio than average, for example. And if you're in a hot climate, you may have a lower expense ratio. So it really depends. You've got to really dig down into the numbers and understand what it looks like. And to the point, I will also look at every single line item of the numbers, because, some people will say, okay, what's the expense ratio? It's 45%. That looks about right. Okay. But the issue with that is that if you understand who you're making a bet on, you've got to get into the details, into the weeds. And there's no better way to get into the weeds than going line by line on the revenues and expenses and understanding some of the assumptions, right? So it's not just about, okay, what is the average income inflation assumption or the rent increase assumption? What is the average expense increase assumption? I came across a deal. Now, this wasn't multifamily, but it's easy to understand. I came across a self-storage deal a few years ago where the average, some things were like being increased by about 2.5%. Some things were increased by 3.5%. And I remember one thing was an increase by like 8% a year. And that stood out to me. So I said to the sponsor, what is this line item and why is it increasing 8% a year? It looks like you have a formula for some. And by the way, why are you increasing some things 2.5 and some things 3? Because that's really unusual, right? Usually just across the board. And they say, look, we actually are basing each increase off of historical from all the properties we have. They're a very big operator with tens of properties. And they said, some things are 2.5, some things are 3. But the 8% was healthcare. And they said, we're not seeing healthcare going up 2.5% a year for our employees. That cost is going up 8% a year on average based on the past 5 years, averaging out. So we're increasing that 8%. So what that tells you about that sponsor, reading between the lines, is that they're probably very specific and very detailed, right? And I happen to be very detailed, and that's a very good personality fit for me, because that could easily translate into other ways, other aspects of their business and how they operate. At least there's a higher probability that's going to be the case, right? So reading between the lines and trying to figure out who you're making a bet on as part of the process is very, very important. So moving beyond the numbers, I typically ask, honestly, an average of 100 to 250 questions. There's stuff that comes up as I'm reviewing the operating agreement, the PPM, the offering documents, including the business plan, the overview, et cetera. And then one thing I typically do with is I always do background checks, not typically, but always. But I typically will meet the person, the sponsor, in person before finalizing my decision to make a bet on them. And that's a final gut check. So what you want to do is take all these steps, right? And I haven't talked about all of them, but take all your steps and do a final gut check and say, is this someone who I want to make a bet on? And what I feel that I found over time is that without meeting the person in person, it's very hard to get a proper full gut check. There have been times where I remember there was one particular deal I did in Memphis where I was on the plane thinking to myself, everything checks out, but my gut check is not the greatest about these guys, but I think it was a good enough deal that it made sense to see them. And I was like leaning towards not investing with them. But as soon as I met them in person and got a much better feel for how they knew the area and everything else, I then left much more confident and I'm like, okay, I'm going to invest. Without that trip, I would have passed on a good sponsor, but it could also be vice versa, right? Which is very important. So I know that's not feasible for everybody as far as travel, time, people are working, but I would encourage meeting as often as possible with the sponsor in person, at least the first time, to make your initial assessment with whether you want to make a bet on them or not. So those are some quick steps. Sorry if it was a little long, but it's
I love it. Topic. I love it. Now, how has COVID changed any of that? Has it been with the underwriting from the sponsor?
Great question. So I actually haven't invested in anything since COVID started. So that's my quick answer for you. I've been on the sidelines trying to understand how this is going to play out as far as how our asset price is going to be impacted in the short term and medium and long term. What is this recession going to look like when we have a potential second round of stimulus? We're recording this in November 2020. There's been a couple of months now since there's been any stimulus, and it's uncertain what's going to happen. Joe Biden seems to have just gotten elected. It's not confirmed yet, and that'll change things potentially too. But I'm waiting and sitting at the sidelines because I'm a very low risk guy. And if I don't have that predictability, I'm taking more risks than I'd like to normally take. So I've been on the sidelines for the most part, waiting to see how it plays out. So I don't have a very good answer for you for that.
I mean, you've answered everything pretty elegantly. So, I mean, we could take a loss on that one, right? So, appreciate that, Jeremy. And can you just tell us how can we stay in touch with you?
Yeah, the best way to reach me, and feel free to reach out to me if you're in a network or just have any questions. My email is the best way to reach me for sure, which is jroll, JROLL, @Roll Investments, ROLL Investments with an S.com. So jroll@rollinvestments.com is the best way to reach me.
Thank you for coming on. As you heard here, everybody, he evaluates his criteria and makes changes as sponsors are changing their game if they're pretty detailed. I love that. I love that strategy. Thank you, Jeremy, for coming on the show. Appreciate the conversation.
Yeah, no problem. Thanks for having me on. I hope this is helpful for the listeners.
Don't forget to download your free copy of the investment tracker. It allows you to track up to 5 investments, compare sponsors, markets, and most importantly, projected versus actual returns. To get your copy, go to www.projectedreturns.com. PI listeners, thank you for listening. As always, we hope this was the best resource for your investment strategy, but also the best use of your time. Remember, if this episode helps you, you can help us by leaving a review on iTunes. I hope you feel compelled enough to share it with someone you think this would resonate with as well. As much as it pains us to leave you, but you know what time it is. Time to go put this into practice. Till the next time we meet, happy investing. PI listeners, I'm grateful for your time and I appreciate you for listening. It would mean the world to me if you went to iTunes and left a rating and written review. Let me know how you feel about the show. It really makes a big difference with getting the podcast out there. Don't forget about our Facebook group, where all of our guests are members of. I'll be there to answer any of your questions, or even questions you might have for future guests. Subscribe so you can get the latest episodes and our fan favorite quick hitters. Finally, I want to keep you updated, so head over to johnfortes.com and sign up for the newsletter. If you're interested in partnering with me, sign up on the contact page so you can talk to me directly. I look forward to connecting with you. Happy investing.